If you have $10,000 sitting in a savings account, invested in a few stocks, or even hidden away because you're waiting for the perfect opportunity, I want to share something important with you. Most people believe that wealth is created by earning more money, but after studying markets, economies, and investors for decades, I've learned that wealth is not primarily about how much money you make. It's about how you think about money, how you allocate it, and how you manage risk. The difference between someone who stays financially stuck and someone who becomes financially independent often begins with a small amount of capital and a series of decisions that compound over time. If you have $10,000 today, you're in a better position than millions of people. But whether that $10,000 becomes $100,000, $1 million, or disappears entirely depends on what you do next. One of the biggest mistakes people make is believing that $10,000 is too little money to matter. They look at billionaires and think their own financial journey cannot possibly compare. That's the wrong way to think about it. Every fortune begins with a first dollar. Every successful investor starts somewhere. The question isn't whether $10,000 is enough. The question is whether you can develop the habits, principles, and discipline necessary to grow it. Markets reward consistency far more than excitement. Most people spend years searching for shortcuts, but wealth is usually built through a combination of patience, intelligent risk-taking, and continuous learning. Right now, we are living through a period of significant economic change. Technology is transforming industries. Artificial intelligence is reshaping the workforce. Government debt is rising. Interest rates are influencing everything from housing to stock prices. These shifts create uncertainty, but they also create opportunity. Throughout history, periods of disruption have produced enormous winners and losers. The winners are typically those who understand how the game is changing and position themselves accordingly. If you have $10,000, your goal should not be to gamble on the future. Your goal should be to understand the future better than the average person and invest accordingly. The first thing I would tell anyone with $10,000 is to invest in knowledge before chasing returns. The highest return investment I've ever seen is not a stock, not a bond, not real estate, and not cryptocurrency. It's education. When you understand economics, business, investing, and human behavior, every future decision becomes more valuable. Imagine spending a small portion of that money learning skills that increase your earning power for decades. That investment can generate returns far beyond anything available in financial markets. Knowledge compounds just like money compounds. After investing in yourself, the next priority is protecting yourself from financial disaster. Too many people focus entirely on making money and ignore risk management. In investing, survival comes first. If you lose everything, you lose the ability to participate in future opportunities. Before seeking large gains, build a financial foundation. Maintain emergency savings. Avoid excessive debt. Create stability. The strongest investors are not necessarily those who earn the highest returns. They are often the ones who survive difficult periods and stay in the game long enough for compounding to work. Compounding is one of the most powerful forces in the world. Most people underestimate it because its effects are slow at first. Imagine earning returns year after year and reinvesting those gains. Initially, progress seems insignificant, but over time growth accelerates dramatically. The majority of wealth accumulation occurs later in the process, not at the beginning. This is why patience is such a competitive advantage. Most investors quit too early, change strategies too often, or panic during downturns. Those who stay disciplined often achieve results that seem extraordinary to outsiders. Diversification is another principle I strongly believe in. Many investors think diversification limits returns. What it actually does is reduce the probability of catastrophic loss. Nobody knows the future with certainty. Not me, not Wall Street, not economists. Since we don't know what will happen, we should build portfolios that can perform reasonably well across many different environments. If you have $10,000, don't place everything into one stock, one industry, or one idea. Spread risk intelligently. Diversification allows you to stay invested even when individual investments disappoint. One of the greatest dangers facing investors today is emotional decision-making. Markets move up and down. Headlines create fear and excitement. Social media amplifies both. When prices rise, people become greedy. When prices fall, they become fearful. Unfortunately, those emotions often lead investors to buy high and sell low. Successful investing requires doing the opposite. You need a system that helps you make rational decisions even when emotions are pushing you in another direction. The market often transfers wealth from the impatient to the patient. Another important lesson is understanding the difference between speculation and investing. Speculation is when you're primarily betting on what someone else will pay tomorrow. Investing is when you're purchasing an asset because of the value it can generate over time. During market bubbles, speculation becomes extremely popular. People chase trends because they see others making money. Eventually, reality catches up. Prices fall, and many participants discovered they were not investing at all. They were simply gambling. If you have $10,000, focus on assets with real economic value and long-term potential. The world is changing rapidly, and technology is creating new opportunities. Artificial intelligence, automation, biotechnology, and energy innovation could reshape entire industries. However, exciting technology does not automatically translate into successful investments. Many great technologies become poor investments because expectations become unrealistic. The key is not simply identifying innovation. The key is understanding price relative to value. A wonderful company purchased at an unreasonable price can still produce disappointing returns. Discipline matters just as much as vision. If you're young, your greatest asset is not your money. It's your time. Time gives you the ability to recover from mistakes, learn new skills, and benefit from decades of compounding. A young investor with $10,000 and the right habits can outperform someone with far more money but poor discipline. Time magnifies both good decisions and bad decisions. The earlier you start building strong financial habits, the greater the long-term rewards become. For older investors, the lesson is slightly different. Capital preservation becomes increasingly important. The closer you are to retirement, the more damaging major losses can be. This doesn't mean avoiding growth entirely. It means balancing growth with protection. Every investor should understand their financial goals, time horizon, and tolerance for risk. Investing is not about maximizing returns at all costs. It's about achieving your objectives while maintaining peace of mind. Many people ask me where I would invest $10,000 today. My answer is that the specific assets matter less than the principles behind the allocation. I would seek diversification across different asset classes. I would maintain exposure to productive assets. I would avoid concentrating risk. I would focus on long-term trends rather than short-term predictions. Most importantly, I would create a plan and stick to it. The biggest determinant of success is often behavior, not asset selection. Economic cycles are unavoidable. Booms and busts have occurred throughout history and will. Economies expand, then contract. Understanding cycles gives you a tremendous advantage. Reasons to abandon your strategy. One of the most valuable habits you can develop is independent thinking. The majority is often wrong at major turning points, objectively, and making decisions, rather than popular opinion. Financial success often requires the courage to think differently. Another critical factor is increasing your income over time. Investing matters, but earning power matters too. The more capital you can consistently invest, the more powerful compounding becomes. Focus on building valuable skills. Learn how businesses operate. Improve communication abilities. Adapt to technological changes. The future belongs to people who continue learning. Your earning potential and investment returns work together. When combined effectively, they create extraordinary results. Remember that wealth is not merely about money. Financial freedom provides options. It gives you the ability to spend time with family, pursue meaningful work, support causes you care about, and navigate uncertainty with confidence. Money is most valuable when it creates freedom. Keeping this perspective helps prevent the endless pursuit of more, for the sake of more. If I could leave you with one final thought, it would be this: don't wait for the perfect moment. Most people spend years waiting for certainty. They wait for markets to become clearer. They wait for economic conditions to improve. They wait until they feel completely confident. That moment rarely arrives. Successful people take thoughtful action despite uncertainty. They learn, adapt, and improve along the way. So, if you have $10,000 today, recognize the opportunity in front of you. That money represents more than a number. It represents potential. It represents choices. It represents the ability to begin building a future that looks different from your past. Invest in yourself. Protect against unnecessary risk. Diversify intelligently. Think independently. Stay patient. Let compounding work. The decisions you make over the next few years could have consequences that last for decades. The biggest risk is not that you fail. The biggest risk is that you never begin. And if you wait too long, you may discover that the opportunity you had today is gone tomorrow. That's why, if you have $10,000, you should think carefully about what comes next before it's too late.